The session opened with a quiet sense of resilience. Futures had hinted at a modest recovery, and traders stepped in cautiously, as if testing the strength of thin ice. There was no surge of conviction, just incremental risk-taking driven by the hope that geopolitical tensions might remain rhetorical rather than material. For a moment, equities drifted upward, not because investors felt certain, but because they feared being left behind if calm prevailed. It was a fragile optimism, built on positioning rather than belief. Beneath the surface, however, energy markets continued to pulse with instability, reminding participants that any sense of control was provisional. As the day progressed, attention gravitated toward oil not as a commodity, but as a narrative anchor. Price moves became signals of fear rather than reflections of supply dynamics. Traders weren't debating barrels or logistics, they were debating escalation, duration, and the psychological cost of uncertainty. The rally in crude functioned less like a fundamental adjustment and more like a stress indicator. Each uptick nudged equity participants toward caution, forcing them to reconsider how much risk they were truly willing to hold overnight. Markets began to move not in response to confirmed events, but in anticipation of emotional reactions yet to come. By midday, sentiment had begun to pivot. Reports of military movement didn't necessarily change the immediate economic outlook, but they altered the emotional trajectory of the session. Markets started trading not the present, but a spectrum of hypothetical futures. Liquidity thinned at the margins as participants questioned whether price discovery was still anchored in fundamentals. In this environment, headlines became gravitational forces, pulling capital toward safety and away from conviction. The earlier gains quietly dissolved not in panic, but in resignation. Across asset classes, a subtle synchronization emerged. Options markets began to price not just movement, but the possibility of misjudgment. This wasn't about forecasting specific outcomes, it was about acknowledging that collective confidence had become fragile. Investors weren't exiting en masse, instead, they were hedging more aggressively, speaking the shared language of volatility. The sense of stress wasn't loud, but it was pervasive, a tightening in the market's emotional bandwidth reminiscent of previous systemic moments. Economic releases arrived throughout the session, yet they failed to anchor sentiment. Mixed signals from consumption and labor demand offered no clear narrative to rally around. Investors scanned the numbers, searching less for growth or slowdown, and more for confirmation that someone else might act first. In this climate, data became secondary to interpretation. The market's reaction function shifted from analysis to anticipation, amplifying the importance of central bank communication in the days ahead. As the closing bell approached, the market wasn't searching for resolution, it was preparing for endurance. Positioning shifted toward flexibility rather than conviction. Investors recognized that the coming week might deliver policy clarity, yet they also understood that clarity itself could introduce new dilemmas. For now, capital chose patience. The defining feature of the session wasn't loss or gain, but the quiet acknowledgement that uncertainty had become the dominant asset class.